Well, thank you for coming today. We at QuotedData wanted to do a panel on investment companies and why they are the largest and fastest growing sector in the stock market. We're very lucky to have our panelists here today. We've been asked to do some questions. So what was invented first? There's an app. You can download it if you haven't already. Please do so if you want to get involved. What was invented first? The ETF, exchange-traded fund, open-ended fund, sometimes called OIC or unit trust, or investment company or investment trust. So please press your buttons now. Good. We got someone got it right. Anyway. There we go. And then hopefully we'll get another question popping up in a minute. There's lots of people. There's at least 1 million people have clicked that button. And when was the first structure produced? 50 years ago, 100 years ago, and 150 years ago. And those who joined Alex's talk earlier should know the answer to that one. Great. There we go. The answer is 150 years ago. First of all, I'll just sort of prove the point. Investment companies, we need to flick to slide. I need this. There we are. They are the largest sector in the UK by number of companies, not in regards to market cap. But you can see they're incredibly large, the total assets market cap, and roughly 1/6 of the FTSE 250. And I think this point is interesting. You know, when you open up the newspaper, a large chunk of the data in the back is investment companies. And I think it's a sector which is that could have a bit more attention to it. You know, they don't have huge marketing budgets, and so they sometimes get looked over. But they are, for myself, a very interesting asset class. Recent capital raisings has been one of the reasons for the fast growth. IPOs, I don't know how many of you invest in IPOs, but there has been quite a few over the last few years. And you can see in 2017, 19, 2016, 7, 2015, 25, we've already had quite a few this year, which we've done research on. And it's really interesting to see these sort of types of assets here. So you've got a lot of alternative assets. We've also got, this is capital raising, not just IPOs, by the way. But you can see this global equity fund here as well, which is good to see. But you can see that the people are taking advantage of the structure. And it does suit slightly more liquid assets and longer term sort of investing. Again, you can see the same number of companies. It's back up to the same number of companies as 2008, but you can see the amount of assets in the space has risen quite a lot. So it really is a space that people are looking at the moment. If this is compared to open-ended funds, you can see the performance generally has been a lot better than OICs, open-ended funds, which, because of various reasons, is much larger than an investment trust, the open-ended world, predominantly from my point of view, from the fact that there's been trail historically and IFAs knew about it. But, you know, you can see this is pretty good performance. Same with ETFs as well. And what I want to do today with the panel here is just run through you know, why that is. And you can see the discounts here narrowing as well. So very positive for the sector. But I'll now move over here to talk to my panel. So we've got Alex here at Fidelity, Alex and Chris and James. Could you just explain a little bit about your what you do at Fidelity and your trust?
Yeah, well, Alex Denny, as you say, Head of Investment Trust at Fidelity. So I look after our range of investment companies. We've got 5 of them. They are regional equity-focused investment trusts. Yes, absolutely. That's me.
Perfect. Thank you. Chris, can you run through the company, your trust, and what you get up to?
Sure.
Thank
yes.
you.
So hello, everyone. I'm Chris Tanner. I'm a director of John Laing Capital Management, the investment advisor to John Laing Environmental Assets Group Limited, which is a mouthful, so JLEN for short. So we are an investment company that's been around since 2014. We hold a diversified portfolio of environmental infrastructure assets, and we aim to pay investors a strong inflation-linked yield. We're on target to pay investors over 6% this year, and every year since IPO, we've grown the dividend in line with RPI inflation. So that's what
Perfect.
we're about.
Thank you, Chris. And James, finally.
Thanks, Ed. Yeah, good afternoon, everyone. I work for Janus Henderson, which is a global investment group. Specifically, I work on the multi-asset desk. We run about $4.5 billion in terms of assets under management. Today, I've got my hat on is as a manager of the Henderson Alternative Strategies Trust, which is a fund of funds, essentially. It's an investment trust, and we focus specifically on alternative and specialist, slightly sort of out of the mainstream asset classes and strategies.
So what I've tried to do is bring people from different disciplines here today to really expose that first question and why the structure has outperformed others. A fund of funds, environmental infrastructure assets, and then also equity mandates, which Alex, I'd love you to talk about now. I showed earlier the performance versus OICs. Could you expand why that closed-end fund structure may outperform OICs, and it's proven to be the case on that table?
Well, I think there's a number of reasons why investment trusts tend to outperform open-ended funds. Some of them are fairly obviously structural. So, for example, the ability to gear up to take debt to gain extra market exposure. The fact that the closed-end structure means you don't have flows in and out of the portfolio means that you can invest in things for the longer term, which of course means that it's possible to invest in asset classes that you really can't invest in open-ended funds to begin with. But also, I think that there's a structural selection bias actually in investment trusts, which is if an investment trust isn't doing very well, then the board of directors of that company can fire the manager, and which sort of really focuses the mind on trying to make sure that you're doing a good job or that you're putting the best portfolio manager on. So where open-ended funds can underperform and carry on for years and years and years underperforming, probably kind of dying a slow and painful death as they dwindle and their assets kind of ebb away, they will still be there. Whereas in the closed-end structure, it doesn't really happen and shouldn't happen. And it's not a theoretical thing, the ability to fire your manager. I mean, if you look at Alliance Trust Savings, sorry, not Alliance Trust Savings, Alliance Trust PLC, they fired themselves as manager and went to a sort of fund-of-fund structure. We've seen a number of people do it. British Assets went to BlackRock and then went to Aberdeen in quick succession. So, there is a real rotation of managers to make sure that we've got the best people working on them.
Yeah, and at Fidelity, given your size, with MiFID II coming through, which may impact maybe the smaller firms, could you just see your fund managers sitting behind their desks and screens? Can you explain how that helps?
I mean, I think that so an organisation like Fidelity, clearly equity managers, we have a very, very large team of analysts, and we've got some good active portfolio managers to invest in equities. MiFID II, for those of you who don't know, European regulation has really upset a lot of the analyst community for brokers by making research have to be paid for, and the presumption that we're seeing going forward is that actually there will be less research available to smaller investment management houses. So there's a structural advantage to being big, having your own analyst team and being able to choose these winners. And of course, in investment companies, you can go and invest in really small, illiquid stocks where, frankly, there wasn't that much research to begin with. So, if the research starts to disappear from the sell side, then it gives an advantage to organizations like Fidelity, where, I can't imagine there'll be that much coverage of tiny micro-cap stocks.
Okay. And then dividend reserves. I know the structure can play well in that regard. Do you have a view on that?
Well, investment trusts, lots of people are investing for income at the moment. And, you mentioned 150 years of investment trusts have been around for. There are investment companies out there that have grown their dividend every year for more than 50 years. And, presuming that those companies can carry on, they could do it for another 50 years. And I dare say that the Association of Investment Companies would love to champion the first one that gets to 100 years of continuous dividend increases. And I think it's probably quite likely that we will see that in 50 years' time. And it can happen for two reasons. Firstly, as you say, they can keep income back in reserve each year. They have to pay out 85% of the income, but they can build up this reserve. So if income falls from their underlying portfolio in any given year, they can pay out a little bit from their reserves. But they can also pay out income from capital, so you can create artificial dividends. So if you want to say to your investors, we will pay you a constant yield of 4%, you can actually guarantee that you will hit that 4% yield.
Yeah, and I think that's quite important, especially in today's environment with, income being on the top of a lot of people's agenda. Other aspects I think I wanted to draw on is the structural issues maybe of OICs and ETS, but OICs in particular. Around Brexit, I remember I said I wasn't going to mention that word, but I have. Around then, there was a sell-off in property, and a number of the open-ended funds fell into difficulty. James, I know you have a large percentage in property, and I think the advantage where you're sitting is that you can see the difference between open-ended funds, and you can pick and choose between open-ended funds and the investment company structure. So I'd love you to just expand on that point, if that was okay.
Yeah, I think property is a great case in point of why investment trust is a brilliant wrapper for less liquid assets. There are open-ended property funds that hold large, very large buildings in them. And clearly there's a liquidity mismatch. These open-ended property funds are offering people daily liquidity in and out. And that's fine normally. Small amounts coming in and out can be managed by the fund managers. But if everyone heads for the door at the same time, they are forced to sell assets. And selling a £20 million shopping centre in a hurry, even in a bull market, is pretty tricky. So the investment trust, closed-ended nature of investment trust is much better. You do have discounts to address. If no one likes property, those property investment trusts will trade at discounts to NAV. But I think the other important thing is these open-ended property trusts, you're not fully invested in property. They're forced to have, I think, 15 or 20% in cash to manage those flows. So if you invest in a trust, you're fully invested. You're getting what you actually want. Yeah,
I think the FCA are even looking into the structure of the OIC, aren't they? And I hopefully we'll see the investment company sector to grow on that point. And we've all got friends in the property industry, and I think in the commercial property world, they're acutely aware of who's managing open-ended funds, because they can buy and sell or push their properties onto them when it's a bull market, because they're sort of forced buyers, and adversely, that's the case in a downward market. But great, Chris. I think today your fund's particularly interesting because of what you're doing. One, financing and the growth in the renewable energy space, which I think is fantastic. But also, you're investing directly in a relatively illiquid place. And I was wondering, how do you find the structure for your investment trust? Does that help you?
Yes, really I have to echo the points that have been made already. the kind of things that we invest in, whether they be wind farms, solar parks, waste facilities, they absolutely are illiquid assets. They take time to buy and sell. And so, quite simply, we wouldn't be able to deal with the kind of inflows and outflows that an open-ended structure might experience. Yes, the structure really lends itself well to renewable asset investment. There's about 4 billion in the sector, and that's grown up in a relatively short space of time, so really in the past 4 or 5 years.
I was reading our monthly roundup of investment companies, and I saw a quote from someone, I can't remember who, but about 50 in Europe and UK, but I think 50% of the new capacity coming online now is from renewable energy.
Yes.
In the UK, and then I think in Europe 85% or the other way around. But
Yep.
it's and I think the financing from structures like this is great. So that's interesting.
Presumably as well, there were lots of open-ended funds that invest in these illiquid structures. So there's a sort of a chain, isn't there? People will invest in open-ended funds that then go and invest in closed-ended funds to gain exposure to these markets.
Yes, there will be a few fund of funds that invest in us. That's absolutely the case. But
yeah, we were just talking about that, and another thing. I'm sort of skipping ahead, but like fees. Why pay for fees? That's one thing that you get in the investment company. Why pay fees? Why not invest directly? Is what I mean. And I think that's sort of gone off piece. But I think it's interesting why people pay to get access to things. So, Alex, for an equity portfolio, could you explain? We touched on MiFID II and things like that, but it'd be very good to get a quick response. Say, can I? I can go direct for listed equities, and I can go direct for some of your funds, or is that maybe not? No.
Well, I mean, active management, I think, is what you're paying for, and for Henderson Alternative Strategies Trust, it's an access play as well. A lot of our investments, individual investors can't access themselves, either because you need a large sum of money, or they're just managers that you just wouldn't come across, or strategies you wouldn't come across as an individual.
And Chris, I mean, it's very different to go and buy one of these projects directly. I think
I would absolutely echo that. I mean, what you're paying for is the origination capabilities, the execution capabilities, and crucially the asset management capabilities. So yes, an individual investor may on an off chance be able to invest in, say, one solar park or one wind farm directly, but there's no diversification there, and the skill set that you need is pretty specialist.
Yeah, I mean, for equities, I mean, clearly it is the active management that you're investing in. I mean, if you look at one of our companies, for example, Fidelity Asian Values, what you're actually buying into is a portfolio of companies which has got virtually no correlation with MSCI Asia, apart from the fact that it is investing in Asian markets, but the companies actually in the underlying portfolio aren't even constituents of that index. So you wouldn't have heard of them, or most people in the street wouldn't have heard of them, but we've got analysts that are covering them in lots of detail. I wouldn't go and buy a high fee paying, pay a high fee to invest in an investment company that was a FTSE 100 tracker. Because you can go and buy a really low-cost ETF. What you want is the differentiated exposure, and you want someone who is actually able to pick the winners. And as we saw, from your performance slide, investment companies are outperforming. They're outperforming the index, but they're outperforming their open-ended counterparts, and that is net of fees. So, will you pay 1% for a 10% return, or will you pay 0.5% for a 2% return? And I know which one I would rather have.
Yeah. Moving on to leverage, the ability for investment companies to borrow, I think it's been a key advantage. Alex, can you expand on that briefly, please?
Yeah, I mean, being able to invest more, so borrow money and gain extra exposure to markets or property or infrastructure is clearly good if you think the markets are going to go up and it's in your favor. If it goes down, of course, you can lose out more. But most companies don't take on the kind of permanent structural gearing. They will normally invest tactically. And the great thing is, if markets go down on you, for example, open-ended funds often have a sell-off and they're forced to sell their underlying investments at a worse price. A closed-end fund can normally gear up at that moment to make more investments into a falling market and therefore see the upside from that. Yeah. And also, because they're long-term vehicles, they can take a very long-term view on debt. I'm not sure what the situation is for infrastructure and property, for example, but F&C, again, a big, high-profile company, foreign colonial, 150 years old, has this week issued 30-year debt because they can take a 30-year view with almost absolute certainty that the company will still be there in 30 years' time.
Yeah, I think that's a company that was investing in Peruvian railways and things like that. It's a fascinating history, and probably in that book on your stand. Chris, I think also the operational leverage element is interesting from your point of view in particular. I thought.
Yes, indeed. So JLEN has a revolving credit facility, 130 million. And that's really there to provide added flexibility to the acquisition of assets. Being able to say to sellers of assets, we have the money immediately, is often a tremendous selling point that may not be there for other investors who may have to call on commitments or indeed go fundraising themselves to get the money. So that's a key part of our attractiveness in the market.
Yeah, and I guess people selling these assets, they know that. It's like when you, if you want to buy a house, they look at if you're a mortgage or cash buyer. And all
everything else being equal, if you're faced with two buyers, one of whom says, I'm ready to go, and another one who says, well, just bear with me while I line a few things up. Certainly in today's markets, people will go with the easier execution.
Thank you. So that was mainly about the good performance of investment companies versus those other structures, OICs and ETFs. But another reason, and you saw, we looked at the assets under management have grown a lot. That is down to good performance, of course, on average. But it's also with, there's been a new supply coming online, these IPOs that I touched on. The last 3 years, certainly, there's been new interesting companies coming about and alternatives and an income sort of options, and taking advantage of that fixed structure has come about, and it's. I'm a big fan of IPOs. I always find them fascinating about the next idea that comes along, and it proves that the asset, the structure is suitable to these sort of things. But Chris, given the structure, do you think this will be set, this is set to continue?
You're talking about new IPOs into my sector in particular?
Yes, actually, yeah.
Well, I'm aware of at least two that are either IPOing or seeking an IPO shortly in the kind of renewables, alternative infrastructure space. I think if you have a good proposition, a differentiated proposition now, and probably you need to say that you have some kind of proprietary access to deal flow, then you've got a good chance. Yeah. I think if you are trying to launch a new wind farm fund or solar park fund, investors will probably say, well, actually the market is well served by established performing names, and if we have more capital for those kinds of things, we're better off giving it to a manager who's already there.
And James, you must see, it must be an interesting place, there at Janus Henderson. You're sitting at your desk, brokers calling in, got an IPO.
Yeah, I mean, it's endlessly fascinating, and that is where the growth is. It's in the more alternative strategies, particularly in the closed-ended space, and everything from renewables, social infrastructure, You're seeing even more alternative niche areas such as reinsurance, catastrophe bonds, where you're taking some of the risk from reinsurance companies, litigation funds, where you can go and take a stake in someone's, they tend to be the big class action lawsuits, and you take some of the winnings when hopefully you win that case. And there are new ideas coming every day, well, not every day, every week. And where we are as specialists in that area, we get a lot of people coming and doing test marketing, sort of running the ideas past us before they actually sort of pull the trigger on going for broke on the IPO.
Yeah. And I guess with your fund, one point I was going to talk about the fees, which we're going on to. So the current stock of investment companies at the moment, have improved probably due to the board points. I think they're keeping you guys in check and making sure that you get they get their bang for buck. Where was I going with that? The current supply, but the fee side, with open-ended funds, and I particularly wanted to focus there. I can't remember this. Are asset managers, let's say a whole pile of buyers and sellers happen at the same time, are they matching that? The fees, well, what are the fees in open-ended funds?
Well, I think that's more about the sort of bid-offer spread, or
yes,
the
exactly. Sorry,
if an open-ended fund is getting steady inflows, it'll be priced at the offer, and if it's getting steady outflows, it will go to the bid. And it depends on the underlying asset class how much that is.
Yeah.
So it's not a world away from a closed-ended investment trust, which will have a spread as well, depending on market liquidity. So it's not too different.
Right. Okay.
The fees in general, I would say that just fees are going down across the board in fund management.
But I mean, you're an institutional buyer and seller. I mean, you look at some of them; they're quite large on the retail side. I've seen up to 5% on some. Are those days gone, or I don't know?
I think, unfortunately, some fact sheets still say that there's a 5% initial charge
there,
which is universally waived until that fund essentially, they call it soft closing, is they basically put up the barrier and they say, well, if you're so desperate to put your money in this fund, you're going to have to pay that 5% upfront charge. But really, it's all about the annual management charge.
Okay, thank you. Yeah, sorry. Thanks for correcting me on the fee point. I think we could talk about discount control measures. Discounts have narrowed. I showed you that chart. And general corporate governance has got better in the sector. But I think one of the most overwhelming points of today is the demand for the investment company sector has soared, and it's simply getting more popular. And I think, Chris, could you expand a little bit on why that is? We've touched on it at various points in the day, but why?
Sure.
Given that there are, do you think is it due to low returns elsewhere, or what's driving all this?
I certainly think in my space, people are attracted to the returns with a very low level of correlation to other investment classes. So really, our returns come from the money that wind farms, that solar parks and so forth receive. They're receiving those in large part through subsidy payments. Those subsidy payments are directly linked to RPI inflation. And so what we can offer is an inflation-linked return that really isn't going to sort of be affected by recent stock market drops, for example. Yeah. And I think that is pretty desirable at the moment, when most of the trusts in my space are offering something around the kind of high 5-6% mark, expected to grow over time. That is a reasonable return.
Yeah, I mean, I assume if investment trusts are taking out 30-year loans, inflation is one of the concerns, and so they're fixing that at a low price, and then they're exposed to equities, but looking for those opportunities where can protect your assets is very positive. Yeah, we've answered that one on IPOs, but there are now different buyers, and actually this is one of the reasons why QuotedData is here today. If you look at investment companies, you look at their share registers over the years. They used to be held by institutions, but they and to their frustration have had to exit because maybe they just grew too big and suddenly liquidity was an issue. But what we've seen now is those guys shifting away in the main. I know, of course, you guys are playing a very smart game, but I think what's interesting, and I look at this closely, is the growth in retail, and that's why we're very keen as a house to get out here and sort of meet you guys. Is the growth in retail has been staggering, and of course they don't have in general. I don't know if Jim Mellon's around, but I don't. But in general, the liquidity isn't such an issue, and I think this is a trend that's set to continue. And I see private investors in the future being the largest shareholders of investment companies in, let's say, 10, 20 years' time. Currently, it's stockbrokers like your Rathbones and a few institutions still there. But I think it's a good structure that does suit, and it's interesting to see that shift in share register. But Alex, sorry, I think I got very excited about that shift because, well, it suits us doing research to the retail market. But could you expand on what I've just touched on?
Yeah, well, I mean, absolutely. In the retail space that we see demand through the platform, as a result, there's been, an increase in a less sort of burden on the supply chain. There's greater availability of this product to the retail investor. Fidelity has added investment trust to its platform recently. The major platforms, Hargreaves Lansdown, Interactive Investor, these are all making product available to the man in the street at IPO. Clearly people are looking for asset-backed, kind of uncorrelated sources of income. If you can add in, kind of a high yield and then indexation to protect you from inflation, there's lots of people who'll bite your arm off for it. And so the fact that they can get access, of course, is feeding into that demand.
Brilliant. Well, thank you. Thank you all for coming down and for me picking away at your areas of expertise. So, I think it's really added to just me boring everyone about, on slides, etc. So thank you very much indeed. I think really from my point of view, the key takeaway from this is just when investing, think about the structure, they all have their benefits, ETFs, OICs, and investment trusts, investment companies. But do think about that structure. So that's really what I came to say. But thank you very much.